They asked me to give a short 15-minute talk on what investing was about, what you needed to do to make money in investing. So I will first start with A, which is asset allocation. And people actually always don't realize that if you did asset allocation, you would have made more money than whatever else you did. The reason is people mistake what is asset allocation, because what is asset allocation is that a certain amount of money is put in equities, a certain amount of money is put in debt, a certain amount of money is put in real estate, a certain amount of money is put in gold. And in this 29 years of working, if you had just followed this asset allocation, what actually would have happened is that in 1992, when the Harshad Mehta scam happened, you would have actually sold equities when everyone was actually buying equities. Again in 1994, when the FIs first came to India and you had Morgan Stanley and many other foreign mutual funds come in and invest, that was a time again to sell in equities. In the year 1998, people may not know that all the companies, big companies in India like Tata Steel and Larsen and Toubro, they all raised money at 16% interest rate in that year. And companies like Tata Steel are I would say the blue chips. And I remember there was one Sardar Sarovar Nigam, which was a government of Gujarat undertaking, which raised money at 17%, if I'm not mistaken. And at that point of time, you're in a situation where the asset allocation meant that you had to buy an undervalued asset class and you would have put money in debt. And if you look at periods after that, which most of the people would know, you had a big boom in 2007. In that boom, asset allocation would have told you to sell equities and buy gold. And in 2012, 13 and all, it would have told you to buy equities and sell real estate. So frankly, all these decisions, which is basically asset allocation, are on paper very, very easy. But in practice, if you look at the evolution of the mutual fund industry, most of the money in the mutual fund industry came in 92, 94, 2007. So in equities, which shows that while everyone says they practice asset allocation, they always did the opposite of asset allocation, which means that in 2007 they bought equities, in 92 they bought equities, etc. So I would say that the simple way to make money is to follow asset allocation. The second, there I was very lucky, and it was not that we didn't know about it. I got a chance in 2012 to hear Warren Buffett in India and Delhi. And I was in a group of about 200 people. And people asked Warren Buffett, what did you learn out of 40 to 50 years of investing? So what he said was, he said that bubbles and busts are very common once a decade, roughly. So he said in this 40, 50 years of investing, you actually will see 4 to 5 bubbles and 4 to 5 busts. And on those bubbles and busts, you have to be rational. So in 1999, there was an article in a famous, the equivalent of India's, newspapers, called Barron's, which said that Warren Buffett has lost its touch because he knows to play bridge with Bill Gates, but he doesn't know how to buy Microsoft stock. And so it said actually the end of Warren Buffett's investing era in 1999. But from 1999 to 2018, he has been one of the best investors because he had to avoid the criticism, because in 1999 there was a NASDAQ bubble, technology bubble. So to avoid a bubble by selling into a bubble and buying in a bust, that is what Warren Buffett says is a very, very easy way to make money. And that is what I would call B. And in India also, periodically you will have bubbles. So if you look at India, there was a real estate bubble, I would call it in 2011, 12, 13. Why did it become a bubble? Because in 2002 onwards, Bombay real estate or Delhi real estate started to go up and went on for 9-10 years. And in those 9-10 years, while equity market had a massive 50% correction in 2008, real estate hardly corrected. So after about 8-9 years of a big real estate boom, you had a situation where people got caught into a bubble, and you know what has happened to real estate after 2012-13. And people think if the more sophisticated the world becomes, there will not be bubbles and busts. But go back just 1 year back, almost the same day, Bitcoin touched some absolutely absurd number, some $11,000 or something like that. And from $11,000, it came to $4,000. So Bitcoin was a bubble. And why was it a bubble? No one knew how to value a Bitcoin, and it was something very mysterious. And so to stay out of a bubble is one of the biggest challenges for investors, because what happens in a bubble is that everyone around you is making money, and you are not making money. So if you are in Bitcoins, every day you could have announced to the people next to you that you are making 5%, 6% per day. And anyone who bought real estate could say my prices have gone up substantially. So I would say that B stands for avoiding bubbles and investing in busts. The third, I would say, is that most people don't realize that investing is a cycle. And effectively, to handle a cycle, I have a guru called Howard Marks who writes free in a website called oaktreecapital.com. And he's a master at cycles. What he says is, essentially, all financial markets are like these old-fashioned clocks. They move from one end of the pendulum to the other. One end of the pendulum is when there is extreme fear, and the other end of the pendulum is when there is extreme greed. So what happens is that to get a situation where people are aware of a cycle is the biggest problem in investing. So what happens is that cycles are, again, people think that you need to know elaborate mathematics, but frankly, people only need to know whether it has gone on for too long. So if you were watching newspapers over the last 6 months, people would have told you that globally, Facebook, Amazon, Apple, Netflix, and Google were invisible, and they would keep going up. And unbelievably, in the last 3 months, those stocks have fallen 20%. And if you take a stock like Apple, it has fallen from 220 to, I think, 150. So that means it's $70 has fallen on 220. So it's about 35%. Has Apple phone become less popular? No, but then the fact is there is a cycle, and the FANG cycle had become so large that stocks like Amazon and Apple were worth almost 2/3 of Indian stock market about 3-4 months back. So that's the beauty of cycles, and cycles will keep appearing. You will be able to identify that a cycle is very, very good when everyone is too positive on something. You will be able to identify a cycle when it is very, very bad, when you will find that everyone wants to run away from it. So I would say that, is it built on some big financial parameters? The answer is no, and you don't need to know finance about it. You actually need to know what people around you are doing. And on that basis, you'll be able to understand a cycle pretty easily. The fourth, I would say, is D, stands for debt for me. And in my opinion, it is the most important asset class in a person's portfolio. And somehow, no, it doesn't have that, what I would say, it doesn't have the thrill of being in equity. But I would say the day you have debt in your portfolio, you actually basically had a very, very good and stable existence. And, most people who are in the mutual fund industry see mutual fund as a equity product. But the fact is that we all have very, very strong set of debt products, which actually will make it much more stable for all of you. And the reason why for me debt was very important was that, I started working in 1989 in equities. And from 1995 till 2003, for 8 years, I would say equity market went nowhere. And in that 8 years, it was like a career holiday for me. And interestingly, I got a second holiday almost from 2008 to 2013. So for 5 years, no one invested in equity from 2008 to 2013. And in my career of 29 years, I would say that you almost had something like a 13-14 year period of holiday. Why did that happen? It happened primarily because of the fact that, debt was not part of my career. So one of the things I went in 2012 and told my boss, the CEO, is that please give me additional charge of debt. And the moment debt has come into my portfolio, it's been much more stable for me, because at all points of time, I find that there is something to do. At all points of time, you are comfortable. So I would say that if you ask me, debt is very important for every investor. And why does it happen is that what I've seen is that in 1998, markets were very, very cheap. In 2002, markets were very, very cheap. But somehow, it was very difficult to move money from a fixed deposit to equity in those years. But I'm very convinced if people invest in the debt mutual fund industry, at the market bottom, as and when it happens at some point of time in the next 10 years, you will have the resources to actually make an investment at the bottom of the market. And that's why I would say all of you have to work on creating a debt AUM, debt products, and you have to invest in debt mutual fund products. Then now coming to E, I think the reason why we are all here, I would say equities is a great asset class. It's a fantastic asset class over the next 10, 20, 30 years. And I would say that it's something which globally has made everyone wealthy. So if you look at the richest people in the world, most of them have made money in equities. And that's why it's always been a great asset class. So how do you handle equities? The way we look at it is one of the most best ways to invest for many people is through invest in SIPs. The reason is that we looked at all past election years. So we looked at year like 2004. People don't know when the election result came, the market came down about 10-12% in 2 days. And if you had invested just after the election in 2004, you actually made huge money in the next 3 years. So if you look back at 2009, it was just the inverse. So if you had invested huge sum of money in the pre-election phase, frankly, you made huge money after the election. And after the election, just the market went ballistic. In fact, the investments you made in January 2009, 4 months before election, they almost yielded 100% return that year. And the January, February installments would be very, very good. On the other hand, in 2014, the whole year the market went up. And anyone who invested in an SIP, the best installments were in January. But anyone who invested in 2014 has had a very, very good investment experience over the next 5 years. Actually, we started thinking of this campaign in end November, but the December elections were very, very interesting. So everyone had some predictions of what would happen if election results came in a particular way. Election results came in a particular way, the market went exactly the opposite way. So somewhere everyone thinks that markets, you can predict market behavior after election. So if you look at it interestingly, in 2004, the Congress government's election success actually led to a 10% fall in the market. In 2009, the Congress government's election success actually led to a 10% rally in the market. So that's the interesting thing about elections, that everyone thinks how they can predict how the elections, how the market will move after elections. But the same government which came into power in 2 different elections produced 2 opposite returns. So we looked at special situations as a theme. And we found that special situation as a theme is one of the most interesting long-term methods of investing. The reason why it's a very interesting method of investing is periodically companies go through problems. So if you look at a company like Nestle, it had a Maggi quality control issue, which led to the stocks coming down. So that was a special situation. So you could buy Nestle, and today the stock is almost 100% higher. If you look at Maruti, it had a strike. And in that strike, you had a situation where the stocks actually fell substantially. And you actually went through a situation where you actually made huge money by investing into that strike. There are, like for example, one of India's largest companies in 2005 to 7, it went through a split. And in that split, whoever invested in the company prior to the demerger actually made huge money because they got so many shares of different companies. And this kind of a special situation keeps happening periodically. So, and there are other kinds of special situations which you have seen over a period of time. Like for example, public sector banks went through a big problem about 5-6 years back because their NPLs were rising. So due to that, all the private banks and NBFCs gained a lot. About 4-5 months back, most of you know that there were some worries in the NBFC side, due to which all the banks have done well now. So you have an interesting situation where periodically problems happen in different sectors and problems happen in different companies. And as a special situation, what is the biggest advantage for a fund manager is he buys cheap. So if you buy Maruti when there is a quality control problem, you actually, through a strike, you buy cheap. When Nestle goes through a quality control problem and you buy Nestle shares, you get cheap. So essentially, we looked and found that one of the biggest benefits of special situation investing is the fact that you buy really cheap. And that actually is the biggest benefit. So what happens is if you keep on buying cheap, different stocks due to different reasons, you actually tend to make a good amount of money in the long run. And one of the questions people have asked me, is it better to invest in good times or bad times? And one of the interesting thing in equities is the best time to invest is actually bad times. It's not very good times. So if you have a situation like 2007, in 2007 everything was going great. So if you invested in equities at that point of time, I didn't make money. In 2008, second half, everything went into trouble. But at that point of time, you had invested, you make good money. So in 2013, you had a taper tantrum. And during that time, if you had invested, you made good money. So somewhere, people think that they should invest in good times. But equity as an asset class is something you invest in volatile times. And the best times to invest are volatile times and not times when there are no problems. So this is broadly what I want to convey. And I would say that the key is asset allocation. The second key I would say is what I learned from Warren Buffett is to avoid investing in bubbles, taking out money in bubbles and investing in bust. The third is to recognize a cycle. And fourth is to invest in debt. And fifth is to invest in equity, specifically through SIP, STP and special situation. I call it SSS. This is how I look at the markets, and I think investing over the next 10, 20 years will be a rewarding experience if we focus on ABCDE and also focus on SIP, STPs and special situation. That's how I look at it. Thank you.
Don't forget to like and subscribe.